Hello, good afternoon, everyone. I'm Emilie Gallagher. I'm our Global Head of FX, Commodities, and Economics Product here at Bloomberg. And I'm thrilled to be joined here by Seema Shah, who is the Chief Global Strategist of Principal Asset Management. So welcome.
Thank you very much for having me here.
So today will be the sponsor spotlight. We're going to be talking about investment trends shaping asset management today. And the investment management industry has been through a ton of significant changes recently. And I'm curious, what types of trends are you watching, and how do you think asset managers are adjusting?
Well, I think in terms of from a macro perspective, firstly, because I think that it feeds into how asset managers have to think through things. The first thing is we've had this wonderful 10 years of easy monetary policy. We've had high returns and low volatility. Well, unfortunately, it looks like that is firmly behind us. So now you're moving into a time where inflation is going to be a bit higher. We think QE is behind us. The central banks are going to be having higher interest rates. So this really means lower returns, higher volatility. In the last 10 years, central banks have essentially done the work for investors. Right? They've made it very easy to make strong returns. But now, when you have an investment landscape which is more challenging with high volatility, we need to be a little bit better at our jobs. Right? We need to be a little bit more analytical. One of the things that we need to do is identify some secular challenges, secular changes, and figure out the asset classes that will give you that exposure. So one good example, of course, is what we've been talking about all day. It's AI. Well, AI, right, you can get exposure to that, but I mean, if you haven't got it now, do you want to be buying right now? No. But you have got other ways of getting exposure. So think about stuff like data centers, which are still riding the AI trend, but they've got better valuations. So there are ways of doing that, and that really takes active management. That takes a deeper analytical approach, looking beyond just your obvious asset classes, thinking about diversification. The other part of it is also thinking about public and privates, right? As I said, this is going to be a more difficult environment to make the returns. How are you going to get your returns? Well, you need to think a little bit more exotically. Think about looking outside of the US, but also think about private markets, which I think for the next 10 years is going to be where you're going to get a bit more of a bang for your buck.
Okay. And I meet with a lot of macro strategists in my role as looking after our economics product. And it seems like there's a consensus and there's a broad consensus that the US will be entering into a recession this year. I'm curious, what do you think some of the risks are that we're not talking about, we're not discussing, and how do investors brace for that volatility?
Well, okay, so the interesting thing is that you're right. So there is a lot of consensus about this US slowdown, and yet there's no conviction. So if you go to your Bloomberg terminals and you look at the economic forecast for the US, for example, you will see that there is absolutely no agreement in terms of timing, duration, and magnitude. There is absolutely no consensus. So on that, there is no conviction. Yep. Another good example is the forecast for Europe, which is really interesting. This is Europe. This is the one that has continuously disappointed. They've struggled to have really strong positive growth. And yet, if you go on your terminal, there is not one forecaster out there who has any negative quarters of growth next year. Right? So that, to me, is a bit of a risk on the horizon in terms of the things that people are not talking about. One of the other things that we see is with regards to the banking crisis. General consensus view that it has passed, the acute part of it is behind us, and we can now just start to think about the impact on lending. Well, when I think about it, I think, well, wow, there's been 3 banking failures. There's 770 regional banks or so in the US. Are you telling me that only 3 of them have mismanaged their duration? I don't know. That concerns me. So I think there's a lot of potential volatility out there, especially when there is consensus but no conviction. And again, this is really diversification and active management. You have to be very, very careful in this kind of environment.
So shifting gears a little bit from risk to opportunities, what are some of the new opportunities that you see for asset managers to capture growth globally, given the dynamic nature of what's happening in the industry, whether it's industry or macro transformations taking place?
Well, so I mean, if you think about it again globally, right? So we put together a valuation map for equities, for example, looking at what percentage of time have various markets been cheaper than they are today. And you look at it, and the thing that's quite interesting is generally everything is fairly green, right? There's been a rally, of course, to date, but historically, a lot of the markets are cheap relative to their history. There's one which isn't, which is the US, right? So yes, the US has got the AI trend. That is incredibly important. It's something that you cannot ignore. But there are greater opportunities, I think, outside of the US for now. One example is Brazil. It's rarely been cheaper than it is today. If you look to Japan, I mean, there's been a bit of a rally. It's lost a bit of its attractiveness. But there is still a vast difference between the US and Japan. Another example is, you can continue to see that with the macro environment, although we've had a complete synchronization of trends, I think, over the last 10 years, partly because of the central bank policy, now you're seeing that change. So there is a desynchronization going on now. Sorry if I said synchronization before, now it's moving to desynchronization, where you have a number of the emerging market central banks in Asia already poised to start cutting rates if they're not already doing so. And the other thing is that in the US, when we start to think about interest rate hikes or potential interest rate hikes, it's concerning. It's a real worry. But if you think about it for Japan, well, that is great news. So to ignore the global opportunity set, I think, is a big mistake. We, at the moment, believe that parts of emerging markets, I'll give you an example, India continues to be very, very attractive. Within Latin America, Brazil is an obvious one because of valuations. The other part of this is in terms of looking out over a longer term scale. So I talked about secular drivers before. Well, one thing is, for emerging markets, yes, there are challenges. Yes, it's a volatile asset class. But if you can look out over beyond a 6-month horizon, well, then there's a lot of growing opportunities, the growing middle class. That was a conversation people were having 2 or 3 years ago. During COVID, people seem to have forgotten that, but it still continues to be the case. China is a worry for everyone today. If you're sitting here, and actually David Hunt made a really great point before, which is about having that home bias. Well, if you're sitting in the US or if you're sitting in London like I am, and you think about China, maybe your first image is like, wow, the reopening story has been really disappointing. You're not seeing the central bank introducing the stimulus that we may have expected. And yet, if you are in China and you're speaking to a lot of the analysts there, that they actually have a lot more of a considerably more constructive perspective. Their view is that actually, if you've been listening to President Xi for the last 3 years, he has been talking about this idea of moving away from a boom-bust cycle to something which is more stable, trying to move the economy away from leverage. So actually, what they're building is a more stable economy, which maybe over the next 6 months could be disappointing, but actually over a 10-year horizon starts to look very attractive. And I keep giving examples, but this is probably one of my favorite ones, is we talked about the office sector in one of the earlier sessions, about office REITs really being destroyed. And it is, partly not just because of the banking crisis, but actually mainly so about this lack of return to office. Well, in London, it continues to be actually a bigger problem. So people really haven't returned to the office. In London, although it's coming back to a bit of activity, it still feels a little bit stagnant. So that suggests like it should be quite concerning. And maybe sitting in the US, it sounds like, well, why would you have exposure to London? Well, actually, the office REIT sector in London has already adjusted fairly significantly. So actually, this is a fairly attractive opportunity. So I think having that deeper analysis of global markets is important. At Principal, what we've done recently is combine our asset management business with the pensions business. So we now, with having that footprint in a lot of the emerging market countries and global developed markets, it gives you the opportunity to have that global investment perspective into local platforms and also put local products available for global investors. So there's a lot of opportunities out there. It's not just the US, maybe there's US exceptionalism, but you don't want to have all your eggs in one basket.
That's really useful. Thank you so much for those insights and joining me today for the Principal Asset Managers Spotlight, Sponsor Spotlight, where we discuss the investment trends. There will be a break now, I am told, a networking break. I am told that we'll be back in this room at around 3:25. So thank you so much.
Thank you.